On the inflation front, it feels like most policymakers, most analysts, most economists are pretty confident that this uptake in inflation is going to prove transitory. But what if they're wrong? What's to give us the confidence that these price rises we're seeing are going to fade away?
Yeah, it's a great question. And I think inflation is the biggest debate at the moment. And one of the things that we've been doing here at Goldman Sachs Asset Management is to invite in external speakers who have an alternative view to us. And so we are in the camp of the speaker we just heard from on your show, in that we do view a lot of the price rises as transitory. And we think that inflation is going to settle back to a subdued trend due to traditional inflation signposts like inflation expectations and spare capacity in the labour market, but also due to some structural factors that have been fast-tracked by the pandemic, like digitization, automation, remote working, and so forth. But when we've heard from external speakers, one of the views that has been interesting in our forum that did challenge our views somewhat is that we've seen this persistence of supply side issues and bottleneck issues for more than a year now, and that could eventually start to feed through to higher prices. But when we dig down in the data, so far it's not feeding through to higher consumer prices. The rise in consumer prices is largely due to the reopening effect, base effects, comparing with a lockdown economy, commodity prices, and those things are likely proved to be transitory. Another interesting notion we heard was that companies may possess more pricing power during this cycle to pass on prices to consumers due to an excess of savings that consumers are sitting on. So far, we don't see that playing out. And so it's definitely something we are keeping in mind. But even when we look at that spectrum of potential drivers of higher inflation, we still come out on the side that inflation will likely settle back to its subdued trend. Just on that structural point, one interesting stat that came out of the Blair Institute in a report this past week was that 1 in 5 jobs in the UK can be done remotely. So these are so-called anywhere jobs. And what that means is that in a post-pandemic economy, we're going to have more remote work, more flexible work, and that will further flatten the Phillips curve relationship. So it's going to take even longer before a tight labour market, which we're still some way off from, will feed through to higher wages.
Well, on the wage pressure front, I mean, how do you reconcile all of the backdrop that you just outlined with the fact that these reports continue to emerge from the US, the UK, and Europe that firms are struggling to find workers in particular sectors? Why is that not going to lead to wage inflation?
Yeah, it's a great question, but that comes back down to a lot of this data at the moment reflecting pandemic and policy distortions. So on the pandemic front, you've seen health concerns lead some people to depart the labour force. That lowers the labour supply and is resulting in some of these difficulties in hiring. Secondly, a lot of parents have still got childcare responsibilities. That's also weighed on labour supply. And then on the policy front, in the US, the enhanced unemployment benefits that some states are starting to expire but will expire economy-wide in September, those benefits reduce the incentives for some low-income workers to look for employment. And so a lot of those factors are going to fade. And last week at the Fed's meeting, the policymakers did appear to have conviction in the fact that the weakness in job growth and the uptick in wages, that will likely prove to be transitory, as well as a lot of the inflation volatility that we're seeing.